Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder of Intelligent Investor, and we have, right in the middle of reporting season, two very busy people. We have Sick Nick, who's going to struggle through the next 30 minutes, and we have Gaurav Sodhi. We're going to talk about the SaaS-pocalypse. That seems to be the issue of the day, maybe the issue of the year, maybe the issue of the decade, I don't know. But we're going to kick things off with a simple question. It is reporting season. Nick, what is the most outstanding result or the worst result you've seen from reporting season so far?
Yeah, so out of the companies I follow, it's the best result is probably Car Group so far. A lot of my companies haven't reported yet, but I thought Car Group's result was actually very, very good considering how far the share price has fallen. So, revenue is growing at, I think, 10%, EPS a little bit higher, all their divisions, so South Korea, Brazil, US, and even their mature division, the car sales operation in Australia, were all going, incredibly well. So management also addressed some of the concerns of AI, just saying how sort of embedded their product is, how much proprietary data they have, how ingrained it is to the actual dealership networks. And I thought they sort of, tackled those fears pretty well. This is a business that has done so well over so long, and I didn't see anything in this result that would be a question mark about its future. I thought it was just excellent, and that the moat is intact and actually maybe expanding.
Great. Gaurav, what about you?
Just before this podcast was being recorded, John, I was actually writing my BHP update. The first line on that BHP update is, "It's hard not to be impressed." It was a stonking result. And look, I think it's easy to be dismissive of miners because when prices fall, prices rise, obviously their profits are going to be huge. But I think if you take a 10-year view of BHP, my first line stands. It is really hard not to be impressed. They've really shrunk this business to hold the best mining assets in the world. And they have deployed a surprising amount of discipline and sound capital allocation. And they've done that for a decade across high prices and low prices. So yes, I'm impressed. This is a properly high quality business. And even commodity snoots who wouldn't buy, the line is,
what's that?
The line that I keep hearing is, we only buy businesses where the things are in their control. We don't like it because, the revenue isn't in their control. Well, there are lots of things that are outside the control of businesses.
Every business has
stuff outside of their control.
Yeah.
And I would suggest that BHP is one of the great businesses on the ASX. And I challenge anyone to look at the result and say otherwise. Stunning.
Yeah. Okay, that's good. Unless you're Vladimir Putin, every investor faces endless risks that they can't control, and even he maybe is an exception to that. We've got a buy below $30 on BHP, and it's a long way from that.
That's too low.
Now, Gaurav.
That's too low. It's going to rise. I can tell you that.
Okay. There's a little preview of what's coming today, folks. All right, let's get on to the big issue. I don't really know where to start with the SaaS-pocalypse. Maybe we should say that for probably about a decade now, SaaS businesses have been some of the best businesses to buy because if they have low churn, especially, they have very predictable cash flows. It's a very high margin business once you've built out the product. They have been absolutely smashed over the past 6 months. This has only really hit the media over the past couple of weeks, but SaaS business share prices have been falling for quite some time. Let's go through a few examples. We've had Technology One's been hit, Pro Medicus, WiseTech. These are some of the best high quality businesses you're likely to find, and they've been absolutely smashed. So let's kick things off with the obvious question, which is why has this sector been hit so hard? Nick, you kick it off.
Yeah, I think it's probably two reasons. The first one is this new threat of AI disrupting these businesses. And then the second one, like you alluded to, is the high starting valuations. If we look at the threat of AI, I don't think the stock prices now reflect that software is going to be completely replaced. They more reflect that the terminal values of these businesses are more uncertain than they were potentially.
What do you mean by terminal values? You have to explain this DCF nonsense.
Yeah, so it's sort of like you when you do a DCF, or just when you think about a business, you would forecast out its cash flows and then give the business an enduring value over time. And usually that terminal value is where a lot of the valuation is made up. So if there's question marks about how durable the cash flows are or how long the business might survive, you might apply a high discount rate to that. So I think that's what's sort of happening here. But there's other questions too, like that go back into the terminal value question. And that's, can these businesses maintain their pricing power, their margins? Can they keep their low churn rates that they have? So there's a lot going on. I think the market's essentially saying that the size of the moat here is shrinking, and there's probably, that's probably fair in some cases, maybe not all cases. And that's pretty interesting. The other side of it is the high starting valuations. I mean, investors have been begging for a sell-off in these names for close to a decade. I mean, you mentioned some companies up front, like Pro Medicus, that got to 200 times sales at one point last year. It's absolutely insane. And also insane. Some of these companies as well, they don't have the best accounting. If you look at the US companies, software companies have been able to convince investors that share-based compensation isn't an expense, and to simply add it back to their earnings in what they call non-GAAP earnings. Yeah. And then in Australia, companies have been capitalizing more software expenses and then spreading that out in their income statement through amortization over a longer period of time. So WiseTech is one of the serial offenders there. So there has been some accounting gimmicks as well. And the sectors has been begging for a sell-off, and we've finally got it.
We are definitely getting it. Now, Gaurav, you seem to be probably the most bearish about software amongst us, I think. Make the case for the fact that there's been a fundamental change in the quality of these businesses with the launch of not just AI, but the agentic products that we've seen over the past few weeks.
Yeah, I think Nick is correct there. What's in question is the terminal value, which is in plain English terms, it's the finger in the air, I don't know part of the valuation, and that's the long dated future part. And there's no question that is now more uncertain now than it was a year or two ago, and that uncertainty needs to be reflected in prices. So you got an added bout of uncertainty, which the market is now willing to price, because it is so obvious. I mean, the advancements in AI, this is a different type of technology. I don't think this is the same sort of panic that came from COVID, or that comes from tariffs, or from higher interest rates, because those are all things that will eventually diminish or go away. The Trump term will end. There'll be a solution for it. High interest rates will eventually fall. But this is different. This is evolving faster than anyone could have thought. It's becoming much more advanced. And in fact, no one knows how these models work, where they're going to go, and they're advancing quicker than any prediction at any time. So I think we have to acknowledge that we don't know where this goes. The market's making all these wild guesses about winners and losers. I'm trying to ignore all that because I don't know. And I'm not interested in trying to forecast or try and guess this moat is fine and that moat is protected. I don't know. But I think the starting point for every investor ought to be that the valuations on these software stocks were silly. We said it many times on this podcast, but especially in Intelligent Investor itself. We wrote about it many times. We didn't have any of these software stocks on our buy list for years and years. Many members complained about it. Our results suffered because of it. But I think that ultimately what's happening now validates that choice. These software stocks got to stupid valuations, and the narratives did not support those prices. Everyone thought these were impenetrable businesses that you could pay almost any price for. As Nick outlined very well, and I think he's been the lone voice in Australia to say this, the accounting has been highly aggressive, to say the least. And if it was me speaking, I'd say it'd be quite dodgy, but Nick is far more diplomatic than I am. So that combination, I mean, I John, the list of companies you rang out, their share prices are down by sort of 50, 60, 70%.
Yeah.
But Technology One still trades on a 50 times multiple. Pro Medicus still 90 times earnings. Xero is and WiseTech are still 40, 50 times.
Mm-hmm.
These prices have gone from ludicrously silly to merely expensive, I'd say. I still don't. We're a long way from cheap. The only stuff that looks interesting are the classifieds. Mm-hmm. And I think the classifieds are now looking pretty interesting. Nick mentioned Car Group. REA is the other one. I think those things, the valuations are far more interesting. You don't have the sort of capex cycle you're seeing in some of these other businesses. And I think the questions around AI disruption are probably, you can poke more holes in them in the case of classified. So I think we ought to be very careful about watching these 50, 60% share price falls and thinking the market's panicking. I don't think the market's panicking. I think this is a very rational response to a proper threat and to years of silly pricing. So be very careful about jumping into these stocks.
All right. So before we discuss, I wouldn't say the opposite opinion, but a different opinion, maybe from Nick. We should mention disclosures here. Nick mentioned the Car Group. That company is in the Intelligent Investor Select Value Fund. We need to disclose.
It's also I think it's in the Growth Fund.
The Growth Fund
it's across
too.
the portfolios. Yeah. It's actually not in the Select Value Fund, but I think.
Oh, isn't it?
No, it's in the Australian portfolios. Yeah.
Okay. REA isn't at this stage, but it might be soon. Is that correct? I don't know.
We're looking at it. We're thinking about it. Yeah.
Okay. So the classifieds are different, but Nick, and I think that's down to the network effects and the history and the information that they've got and the resilience that consumers tend to have with a brand that has been around for a long, long time.
Well, they're just really good products, and consumers don't pay a lot for them, so it's difficult.
And they can probably be improved
disrupt
with AI, and they are being improved with AI. So I think they've got dominant market positions, and I'm personally a lot more optimistic about classifieds businesses than the general SaaS sector.
But I agree with that.
What are the reasons why this might be overdone? Because whenever we get these massive technological swings from Silicon Valley, they are just so good at talking their own book, and everybody just buys into it. And it turns out that they often are right, but instead of it taking 2 years, it takes 10. Or instead of it creating massive disruption, it just creates some kind of changes. And we've seen that with the cloud. We've seen that with the internet when it first started around .com by the turn of the century. Is AI going to be like this again? Are they just, again, talking their own book? Or is this something different?
Well, I guess...
Say it, Nick. Say it this time. It's different. Someone has to say it in this podcast.
Come on, Nick. It's been 20 years. Get your mouth around the words.
I'm going to give a diplomatic disclosure that you need to be, keep an open mind. Anything can happen. No, you do need to keep an open mind. And look, the argument or the pushback against everything has changed is a lot of the argument seems to be that, before AI... developers and the scale you needed to roll out software was really the main advantage of these companies. That now that that's been solved by Claude, these companies have no other major competitive advantages. And I think that's a little simplistic to me. For some businesses, it's probably the case, but for others, it might not be. And while coding's, it seems like it's far easier to do now using AI, and you probably only need a handful of developers and a couple of weeks to come out with a commercial product compared to years and hundreds of developers before. Coding is only a small part of building a software product. So there's other things like implementation, security, system design. You need to like solve bugs. You need maintenance. You need to upgrade the product, and then most of all, you actually need to go out and find the customers and sell the bloody thing.
Yeah.
So, like, this is hard to do, and we've seen previously many companies with inferior software products, or what I would consider inferior software products,
Microsoft.
actually be
Yes,
actually,
say it,
actually
Nick,
be the
Microsoft.
winners. Actually be the winners in a lot of categories. If you look at Zoom and Teams, for example, or even Excel and Sheets, you could argue Zoom is a far better product than Teams, but Microsoft puts it in a bundle. It's sort of good enough. They have all these customer relationships with enterprises across the world, and it sort of gets by. And maybe there's a case that that those advantages remain here. The other big thing, or other big pushback, is proprietary data. These AI agents and external AI agents don't have access to the same data in some cases that the incumbents do. And arguably, this data is now more valuable in AI world, where it can be crunched and analyzed far quicker than before than it was previously. So that's a major advantage, I think, for certain companies, particularly those that are really mission critical businesses that are hard to rip out, or that have high switching costs. So that's one thing going for some of them. And then, lastly, is this sort of push from CIOs or chief information officers over the last decade to actually reduce the amount of software vendors. So there was some survey, I think I saw a couple of weeks ago, that suggested that enterprises around the world, a large enterprise, has between 300 and 450 different sort of software vendors within it. And what they've been trying to do is actually, shrink this and deal with less vendors. The idea now that you want to unbundle everything and have 1,000 different vendors from 1,000 different startups and 1,000 different points of contact seems like, it's a bit far-fetched to me. And so maybe the incumbents using AI are best placed to actually become more efficient in their own business and roll out more AI products across their existing customer bases. But they have the advantage too of being able to trial these products with their existing customers immediately, rather than going out and having to find those customers. So the incumbents do have advantages here. Whether they're stronger than they were before AI, I think, is a big question mark, and probably reflects the fall in share prices. And each company really, has to be looked at on an individual case.
Yeah, I would say that generally, I think investors underestimate the benefits of incumbency. I think we underestimated the benefits of incumbency when we suggested members get out of Google a couple of years ago, and I think that there's a strong case to be
John,
made.
can I just say, like, this is how quick things are moving. That wasn't a couple of years ago. That was 10 months ago. The world considered Google all over. It was, ChatGPT is going to, and now it's the complete opposite. Like this is how quick things can change, and how quick we've been to sort of say that incumbency is dead in the case of Google. Sorry.
Well, look, if I was to put myself in the shoes of a Fortune 500 CEO, which I can't imagine that ever happening, and nor would I want it to happen, and nor would the business want it to happen. But if you imagine yourself in that position, do you really want all of your developers going off and playing around with AI, speculative products on AI, and maybe you'd have a few of them, but this is not your core job. I think when you looked at the productivity benefits from developing AI internally versus the costs that you could reduce by halving your development team, I think they're going to go for halving their development team every time. And they would probably prefer the people who are selling them the corporate software to go off and have them deliver the productivity benefits through the products they've already got. And I'm not saying that's across the board, but I just think that case is being really understated at the moment. And we might see some opportunities come up down the track if this continues so much longer, because there could be a time when some of these companies do get to be quite attractive. I'm not suggesting that companies like Monday.com are especially, attractive businesses. I don't think they are. There's a lot of kind of productivity and to-do list software that we use in corporations that isn't that great. The incumbency aspect, though, in blue chip businesses is really, really strong. Gaurav, you sort of gave some indications that you disagreed with that in our meeting on Monday. What's your thoughts?
It's more really, John, about uncertainty and valuation for me. I think it's a mistake. What I see every investor trying to do, and we're all reading the same articles, we're all seeing the same pieces of work. I think they're doing the rounds because everyone is trying to solve this particular problem. Which businesses are going to survive, which moats are going to remain. I think those are the wrong questions because I'm not sure those can be answered. And that's where investors are tending to focus at the moment. You can see the markets giving their verdict on very specific companies. And Monday now trades, I think, on single-digit multiples. Adobe, DocuSign have been completely savaged. And yet many companies still, PME, Technology One, Xero, WiseTech, these all trade on sort of 50 to 90 times multiples still. So the market is delivering its verdict and is telling you where it's landing. All I'm saying is that this is a piece of tech that's moving really fast and aggressively in directions that very few people predicted. And so the degree of uncertainty here is really wide. And we need to be very careful about the prices we pay. For me, it's more really about, this is a question about a valuation question. This is not really a predictive exercise because I mean, software is not really my wheelhouse. So perhaps there are some who can do a better job of prediction. But for me, this is really a question about valuation. And from what I have seen on the ASX, because Nick may get a chance to look at the international stuff. I do not. From on the ASX, there aren't many. In fact, there are none. I own exactly one tech stock, Energy One, which I've held for years, and I have not been tempted by any others. I'd say REA has been the only one I kind of looked at and thought, well, this looks kind of interesting, but haven't pulled the trigger on it. And we're looking at it as a business.
So you're not piling into Life 360 right now.
Look, I think we've probably been a bit dismissive of Life 360. Every young person I speak to, everyone between the ages of 20 and 30, they are on Life. There is definitely a behavioral change where people are willing to share their locations, and there's not too many Aussie products that get to sort of $90, $100 million users, 100 million users. So look, maybe that'd be on the list to look at some stage as well. But again, I come back to these valuations that these are still wild. We're coming from
it's
a world.
Still got a 3-digit PER.
Yeah. And look, I'm not sure forget about the PER. I'm not sure the business model has yet been proven. At least WiseTech, Xero, Tech One. Wow, what an amazing business! These are phenomenal companies, right? With phenomenal economics and business models. Like these are companies we'd want to own, but with the new degree of uncertainty, we really need to be careful of prices. Is my only point. Look, the only thing I'd say about the AI threat and disruption, which I don't know about, but there are everyone's worried about software being replaced or removed by AI. A large part of the attraction of these stocks is the ability to raise prices every year by at least CPI, but often far more than that. So squeeze this pricing power. And at the very least, more competition removes that optionality, I think. So at the very least, it's going to be much harder to pull that price lever for pretty much every software stock. And I can't see why that should not be controversial. That seems evident to me. That's absolutely clear to me. With more competition, it's harder to, even if the competition is not as good or difficult to implement, you cannot just raise prices when there are competitive threats, especially when the cost of software development has basically fallen to near zero.
And there are real concerns, Gaurav, about the business model too. So like SaaS has been really based off this seat-based pricing model where,
yes, good point.
More humans or more employees, software companies can naturally grow with that. If you're using AI agents to automate more of these processes and potentially use less human beings, then that's a real headwind to that growth. And you're already seeing some software companies shift to a usage-based model. So WiseTech is now billing or trying to bill on freight volumes rather than seats. So it's trying to get ahead of this change. But like we've seen with other business model changes, like, for example, going on-premise to cloud, the original SaaS, business case, there's just more uncertainty when this happens. So the share price reactions here aren't, they're not necessarily wrong. It's just they have been indiscriminate, and not all software businesses are the same. Classifieds aren't software. Financial data providers, aren't necessarily software. Insurance brokers were brought up last week, and so it is getting wider. So I think there are some opportunities emerging.
Yes,
but
you're right.
We need to be careful, and like you said, we need to look at valuations, because for some companies they've gone from absurd to merely expensive.
Yeah, you're right, Nick. Some of these adjacencies are quite interesting. You mentioned insurance brokers. I think that is an interesting area to look at. And there are other adjacencies that we are looking at, which I'm far more excited about, and I think look far more promising than, buying Xero or something.
Yeah, we won't be buying Xero.
Yeah, and I just think it's interesting that I'd like to try and keep a finger on the pulse of what investors are saying. I really firmly believe in this view that you have to do something different. You have to be right. I know everyone's aware of what's happening to these share prices, but every investor keeps telling me and telling us as a team, I think, and you read anything and the opinion is all the same, that there's been an overreaction, that the market's got it wrong. Look, I'm just, I just think we need to pay some degree of respect to the collective effort of the market. I mean, the market can be wrong; it's often wrong and overreacts and does lots of silly things. But this is quite new. Like this is an area that no one knows anything about, and like study after study has shown that when in times of absolute uncertainty, when no one knows where the guesses or estimates are going to be, collective guesses are far more powerful than individual guesses. It's different if you have a different degree of knowledge, or if there's some psychological factor driving movements or guesses. But when in complete unknown circumstances, like guess how many M&Ms in a jar, collective responses are always more accurate than individual guesses. You read that book, John? What's it called? The Wisdom of Crowds? That's basically what they're saying. It was that when information, in information gaps where uncertainty is high, collective guesses tend to outperform. And I think we just have to keep that in mind, that it's extremely arrogant to dismiss some of these verdicts that are being issued.
Yeah, it's a great observation, but it's in direct conflict with the idea of value investing and doing something different.
Well, I would say that usually when we exercise our value investing muscle, we're kind of, what we're doing is pattern recognition, reversion to the mean. It's never different this time. When it actually is different this time, that's when maybe we should defer to the wisdom of crowds. There, I said it. Only had to say it. I said it. It is different this time. I think this is different.
I knew you'd be the one to succumb. But look, we've only got a few minutes left. In the final few minutes, I do want to ask Nick about how, if you're looking for opportunities in this sector, and Gaurav kind of isn't right now, but I think as a team we're looking at things with more interest, because that some companies do look far more attractive. We've already found a couple of buy recommendations which we're quite excited about, but Nick, you published a framework for how to think about this circumstance right now in terms of finding opportunities, and you posed 4 questions. So I'm gonna ask you each of those 4 questions. If you could just quickly summarize the answer to each of the question you posed, right? So firstly, out of the 4 things that investors need to do in order to answer the question as to whether there's value there or not, aside from the price, the first question is, what does the software do? Why is that important?
Well, it's important because software is, the range of software is so wide. So if you look at a consumer-based software, say like Shutterstock that we use sometimes at work, I mean, that's been almost completely replaced. It's gone, right? Like that. So consumer software where there's lower switching costs is very different than ripping out WiseTech that is mission critical and has this entire ecosystem wrapped around it with freight forwarders, regulatory agencies. So you actually need to not just not just consider, is it software or not? You need to consider what the software actually does and how mission critical that software is to an operation. The more mission critical it is, the higher the switching costs. And that's always been the case, and it's still the case with AI. Maybe those switching costs have been lower, but there's still one compared to others.
Right. And if you think about that in terms of terminal value, to bring it back to the original, where we started with this conversation, something like Shutterstock, the terminal value might be like that business could decline at 30 or 40% a year, which is wrecks the terminal value. But if you look at something like WiseTech, even if they lose 10% of their customers a year, that means that they'd still be operating in a decade's time, and the terminal value would be so much higher because of that duration. Is that correct?
Again, but I would exercise caution. Just this. Remember what happened to BlackBerry and any other time there's been disruption and the market's onto it. The disrupted asset, the asset prices crumble way before revenues and profitability crumbles.
Agreed.
Yes.
But I think that you can say as a shareholder in these businesses, even if the share price crumbles, you can still, well, look, I suppose the point I'm making is that this is a way to think differently about different software companies. Like what kind of lock-in they have does make them more resilient than something like Shutterstock, a consumer business like Shutterstock, which can disappear not necessarily overnight, but in a matter of a few years. So the second question, is the software a platform? Why is that important?
Yeah, so by platform, I sort of mean sort of like an ecosystem. So is it third parties coming in and transacting or, linking on this software? If we use WiseTech, it's a good example. You have all these regulatory bodies from hundreds of different countries, potentially states as well. You have shipping companies, freight forwarders, all interacting and creating a network effect. And we've found over time that platforms and network effects are pretty bloody hard to disrupt. There's also all this information that is passed between these groups that a startup would struggle to reproduce. So that it's not that these companies can't ever be disrupted or a platform can't be disrupted. It's just that, again, there's just a much higher switching cost for these customers. The same with maybe a Xero, probably to a lesser extent. It's somewhat consumer software. I mean, it targets small, medium businesses, but sometimes they're just sort of individual employees almost, or employers. And, you can bring in your accountant. You can link to that. You can link to bank feeds. It has about 1,000 apps on its marketplace. And though I know we don't love the business, there is an ecosystem and platform effect here that may, prove more sustainable than some, suggest. So I think that this being a platform just gives it a bit more defense, I guess, compared to some other software that's more on the periphery or is mainly used for one specific purpose rather than a wider purpose with more third parties.
Which is why we've got a preference for the online classifieds, which do operate a platform and are locked in a way that you described there. Number 3, is the software horizontal or vertical? Why is that important?
Yeah, so quick definitions. Horizontal software, the easiest way to think about it is something like Microsoft Office. If you're an engineering business or a hospital, you probably have Microsoft Office. So it's used in various different industries. Other examples might be Salesforce or ServiceNow. They're some of the main ones. Whereas vertical software is much more like a WiseTech, where it's used just in logistics. And what we've found with vertical software is the level of business know-how you have to operate in a specific industry is just a lot higher. And again, that just increases the switching costs. Whereas with horizontal software, it's a lot of it is very much trying to fit, a square peg into a round hole. It works sort of good enough, but isn't really designed specifically for, an industry, let alone an individual business. And I think that's just potentially more at risk compared to something that focuses on, a vertical, particularly if, I used WiseTech as the logistics example. That's a big industry. If you look at, say, a company like Constellation Software that owns thousands of these little businesses that operate in specific niches, an example there might be the ACT government's corrections offender software. Now, like the lock-in for that and the business know-how and all that is just far higher than it is for a piece of horizontal software.
Can I just comment on that on CSU in particular and Constellation? I think that's a good example of a sensible bet in this environment, right? Like I don't own it, I don't buy international stocks, but that's where the market's sort of delivered a verdict. The valuation has been crunched, and I don't know whether it will get disrupted or not, but it is well diversified. It's in all these niches. And what is it, Nick? Like 15 times earnings or something? It's that at that price, the odds are a bit more in your favor. You've been compensated so much for all the disruptive risk. Whereas we're being asked in Australia to still pay 50 times earnings for these stocks, and that's why I'm so animated about it. Like there's a big difference in paying 14, 15 times for Constellation and 50 times for Tech One.
Yeah.
Look, let's get back on track.
Sorry, get back to it. Yeah, continue, Nick.
No, I'm enjoying your interruptions, Gaurav. But the final question, also important, probably not as important as the price, but maybe. Who is the customer? Why is that important, Nick?
Well, it goes back to what I was saying at the start. I think the most vulnerable is this sort of consumer software, so where the customer is the consumer, just because the switching cost for consumers is just really low. Whereas if you compare that to switching out of, say, a government, customer, and if you use the ACT government as an example and their offender management software, the likelihood of them switching with all the regulatory requirements, all the compliance there is just far higher than it is for a consumer. So on one end, I think almost the worst customer you can have in some ways is the consumer. Maybe the best customer in this new environment is a government or an enterprise, and small business sort of maybe sits somewhere in the middle. So that's how I'd range it. Again, a lot of companies aren't going to tick all these boxes, and just because it sits in the horizontal bucket or as a consumer product doesn't mean they're necessarily bad and going to get disrupted. It's just more trying to think about these things through a framework.
Okay. I think that's really useful, Nick. My personal guide will be whether the Bureau of Meteorology can build a new website for less than $100 million. If they can, then I think AI has proved itself. Okay, I think we'll leave it there. Just before everybody goes, I do want to remind listeners that we do have a secondary offer open for the Intelligent Investor Select Value Share Fund. It's performed very nicely since inception a few years ago. Total returns at the end of January 2026 have been 15.1% per annum. That's outperformed the index by quite some margin. The S&P ASX 200 accumulation index has returned 11.4%. Nick and Nathan are presenting at a webinar tomorrow, which you can go onto the website and have a look. They'll be talking about some of the stocks that we own and the strategy in the fund. Many of the analysts are invested in Select Value Share Fund. It has international exposure and ASX exposure too. So it gives you some international diversification, which I feel a lot of members are missing. If you do want to apply, you need to do so before Friday next week. And to do so, you can go onto the website offer.intelligentinvestor.com.au/IISV. That's offer.intelligentinvestor.com.au/IISV. Okay, that's it. Thank you for listening.